All right, today is Thursday, August 27th, and this is a post-market review for the stock market activities today. We have a lot to cover today. We're going to look at the closing of the market, the sector's performance, the futures performance, the options performance, the headlines of the day. Of course, we do have the Fed's decision. We will discuss that in details. And of course, we're going to look at some charts, the SPY, the Triple Q, gold, VIX, the TNX, the 10 years, yield, and then we will conclude by the implications of the Fed's decision on the market overall and the economy, and of course, the implications of the new testing kit from Abbott on the rotation trade. So here we go. The diamonds closing in the green, 160 points, 0.35, or an increase of 0.57%. The Nasdaq lagged today, closing in the red by 9 or 39.72 points, or 0.34%. S&P 500 closing in the green by 5.82 points, or 0.17%. The sector's performance, the gold medal goes to real estate. Look at that. Very rare to see, but it happens. And the silver goes to the financial sector. And finally, the bronze to consumer defensives. And the laggards of the day are communication services, aka Facebook, and basic materials, and of course, consumer cyclicals. What about the futures market? The laggards, of course, gasoline due to the Hurricane Laura took a real hit today. OJ, of course, we sold OJ at the highs, and that was a very good decision. Look at OJ trending lower. Metals across the board, with exception of copper, are muted, taking a little bit of a hit today. And of course, the outperformers are coca. Coca continues the rally to the upside. Lumber, no stopping sign here, no surprise. Well, what about sugar? Sugar rebounded today. Of course, I missed it. I was waiting for 12:45. That didn't happen. And sugar rallied without me. And of course, oats. We saw rally in oats. I like the movement in oats, the reversal of the reversal. So I bought contracts on oats. This is now my only futures position. So I'm waiting and watching oats to start rallying from here. And what's going on in the casino? Not so hot today. A little muted. The gamblers are kind of tired from yesterday. And you see the action pretty much in Microsoft. This is, of course, with the whole TikTok saga. We had news that Microsoft is buying TikTok now, a confirmation of some sort, but it's still not in stone. Yet the gamblers are betting 85% calls here in Microsoft. Huge volume betting on an increase of Microsoft. And of course, you know that the majority of the calls bought today are expiring tomorrow. So any bad news re Microsoft, say Oracle now is getting the TikTok deal, and those calls are going to expire worthless. And the stampede, of course, in Apple continues, even though the record date for the split is over, but the volume is a little down, of course, way down compared to last week. 70% here of the options volume is to calls. And check this one out. Walmart coming at the third place with 90% of the volume traded for calls. We of course had headlines, and we will discuss that when we talk about the headlines of Walmart joining Microsoft to buy TikTok. I don't know what's the point here and why are traders and gamblers thinking that acquiring TikTok is a good deal. TikTok is some application where teenagers dance and post videos, and it can be disrupted easily, and these companies are going to shill billions and billions of dollars for it. I see that as a negative, not a positive, but you have to play the game. If the gamblers and the Robin Hoodiots going to go one way, if you can't defeat them, you have to use them to your advantage. Case in point, today, the moment we saw the news of Walmart acquiring TikTok, or thinking about acquiring TikTok along with Microsoft, I released a tweet suggesting that you should buy calls on Walmart. And as you can see, I did buy the 136 calls expiring this week, tomorrow, and the stock popped really higher, and I closed them right away an hour later for about 40% gain. So again, use these useful idiots to your advantage and make some cash from them. And now, switching to the headlines that shaped the day. And the first headline, of course, is unemployment claims for the week, and they came at 1 million. We're still trending above 1 million for weeks now, but this news of the weekly unemployment claims were overshadowed by, of course, the Fed. So let's talk about the Fed a little bit, because it was a massive decision, a very critical decision that will change a lot of things in the economy for years to come. The decision goes as the following. going. Let me give you a little bit of a background first so we can be all on the same boat. The Federal Reserve back in the Bernanke era decided to set an inflation target of 2%. Meaning that they will control interest rates and suppress them. However, if inflation shoots above 2%, then they will have to hike interest rates to control inflation and push it down below 2%. Now, that only happened twice, in 2012 and 2018. Beside that, the Fed been lowering rates and keeping rates as low as they can, and inflation still hasn't picked up as expected. And that leads us to the Fed decision today. The Fed decision, in a nutshell, is an abandonment of the Phillips curve. And if you took a macroeconomics class before, you know what the Phillips curve is. It is a theory that suggests correlation between inflation and unemployment. And of course, we know that this theory is garbage and is not applicable anymore because the Fed been lowering rates forever and inflation hasn't picked up. Of course, there's a difference between core inflation, what the Fed considers as inflation, which in my opinion is an outdated way to measure inflation. You want to see inflation? Come over to California, any grocery store, and you can check inflation for yourself. The prices are too high, rents are too high, real estate's too high, asset prices in the stock market too high, everything's too high. But again, the Fed has its own formula of core inflation index. It is outdated, but this is what they use, so we will play the same game in our analysis. And by the way, if you have a macroeconomics book, grab that book, throw it out of the window, because it's all garbage anyways. And if you're in college and your professor asks you, why did you throw the book away? You can tell him to get lost and find another job, because your job is useless. You're teaching garbage. It's a book with a bunch of theories that work until they don't. Here is my problem with the Fed's decision. Remember, what they're going to do is saying, look, we're not going to abide by the 2% inflation rate anymore. Meaning, instead of keeping the 2% as a ceiling, this is inflation, of course. Instead, we will let inflation ride higher for a little bit, and we will use the 2% as an average goal. Meaning that inflation can fluctuate up or down so long as the average is 2%. Instead of the 2% being a ceiling where you have to do something to push inflation downward from there. This is the decision in a nutshell. There are a lot of problems and fallacies with this decision, so let's go and discuss them. Fallacy number one. The Fed is assuming that they have the power of controlling inflation single-handed. They don't have that power. They have the power to spark a reaction in the economy, to elicit inflation or suppress inflation. That is it. Furthermore, when they lowered interest rates the last decade, and they keep lowering them more and more, what happened is we saw inflation. The inflation is in asset prices, as in stocks and real estate, but we haven't seen inflation in the economy regarding consumer purchasing power, regarding the core inflation index. They lowered it and lowered it and lowered it. That's their interest rates, of course. But inflation hasn't picked up beside real estate and asset prices in the stock market. So what makes them think that if you just let things be, inflation will pick up automatically, specifically when we are in the middle of the recession of the pandemic? What they need to do now is they're going to watch and they will see that inflation is not picking up as they expected. They need to spark the inflation again. How would you do that, Federal Reserve? They will have to go to the negative rates territory. That's the only tool they have now. They have no tools. They've already exhausted all their tools. Let me read from the Wall Street Journal. Here is Jerome Powell saying the persistent undershoot of inflation from our 2% longer run objective is a cause for concern. Mr. Powell said Thursday, while it might be counterintuitive for the Fed to desire more inflation, particularly given rising costs for certain items like housing, Mr. Powell said that the Fed needed to avoid an adverse cycle of ever lower inflation and inflation expectations. So let's dissect this, the stupidity of this statement. He is assuming he's aware of the problem that housing is becoming inaccessible to most Americans, and inflation is already there in certain asset prices, and its implications in the consumer purchasing power is negative. But what he's saying is the expectation of lower inflation is somehow preventing businesses from expanding and from hiring. And if we adjust those expectations by saying, hey, inflation will increase, and the Fed will increase inflation, all of a sudden that will scramble businesses into panicking and expanding and hiring before the inflation hits to take advantage of low costs. That is a stupid moron theory because it doesn't take into account all the different other circumstances that we have in the economy and the pandemic and everything else right now. This is a very 1960s and 70s ways of thinking. Continuing, this is the Wall Street Journal saying, the dynamic is particularly troubling because expected inflation feeds directly into the general level of interest rates. He said, this is quoting Powell, lower inflation deprives central banks with already low interest rates of tools to counter-react downturns. Again, this is the stupidity again. If you're going to lower interest rates to negative territory to increase inflation, well, now you don't even have tools anymore. So saying that, oh, we have to increase inflation so we can have more tools to prevent further downturn, we're already in a downturn. So again, the Fed is not thinking clearly here about the decision. Now let's go to fallacy number 2 of the decision. The Fed is now assuming that there is a direct correlation between inflation and unemployment. So on one hand, they're abandoning the Phillips curve. On the other hand, their decision is pretty much factoring in the Phillips curve. They think if they increase inflation and they let inflation go rampant, somehow that would translate into lower unemployment. And I'm reading from Forbes magazine right now. One of the ways the Fed can now do that, talking about increasing inflation, of course, is by keeping interest rates lower for a longer period of time. That would mean that borrowing costs will remain lower for consumers and businesses, which would hopefully spur hiring and economic growth. So this risky strategy is hopefully will increase employment. This is the stupidity again. Here was a tweet. I tweeted at Steve Leisman, whatever the hell his name is, from CNBC. He's the economist in CNBC. And I said that there are secular factors driving unemployment now. One of them, and the most important one, is companies are now figuring out how to do more with less. They're becoming very efficient. They're realizing that the work from home environment is just fine and they don't need employees as they used to before. So it is not a problem of companies saying, oh, we can't hire because interest rates are too high. Interest rates been low for years. That is not the problem. And again, the problem is not inflation. Companies are not saying, oh, because of low inflation, we're not hiring. They're not hiring because they don't need employees anymore. So all of what you're going to do by lowering interest rates further to increase inflation while the GDP is down, while unemployment is going to remain high because companies don't need employees. Whether you lower interest rates further or you increase inflation, it doesn't matter. They don't need employees anymore. Things have changed permanently in the economy. And all of what this would do when you factor in lower wages and lower incomes that will not increase in correlation with inflation as they assume. You will see a lowering of consumer purchasing power, and that would lead into a phenomena called stagflation. Stagflation, of course, is the worst possible economic outcome you can live in because it could persist for years and years and years. The famous case, of course, is in the late 60s and 70s all the way to the early 80s, when America experienced the worst stagflation in its history. The Fed, of course, lowered interest rates in the 60s when the economy was suffering due to the Vietnam War and other factors. They lowered the interest rate thinking that that would help the economy recover. What it did is it increased inflation, and inflation got out of hand. The Fed thinks that they can control inflation, but in reality, they cannot control inflation once it gets out of hand because there are many other factors determining inflation beside the Fed's rate. And here is a quote from Jerome. He says, any overshoot of inflation will be moderate, won't last for prolonged periods. How can you guarantee that? Should we take your promise for granted? Of course not. And you see that translated, and I tweeted this tweet at Muhammad Al-Arian, who's an economist, used to work for PIMCO, now for Alliance, and I mentioned that treasury yields in the higher end of the yield curve, meaning the 10 and beyond to the 30, will increase. The yields will increase while the shorter end of the yield curve will decrease. And you're seeing this phenomenon is already happening. You saw yields rallying today in the 10 years and the 30. And the reason is investors are going to say, wait a minute, if you're going to increase inflation, what guarantees that inflation is not going to get out of hand and will surpass 2%? You're offering me a 10-year note and a 30-year bond for 0.6%, and for the 30 about 1.3, 1.4%. That doesn't cut it, because when you factor in inflation, I'm losing money on the bond. The yield is actually negative when you factor in inflation. You gotta kick in the yields higher to make the bond worth it to purchase, because I'm going to hold the risk for 10 years and beyond. You got to pay me a yield that surpasses inflation and factors in inflation. That, of course, will increase yields at the higher end of the yield curve. Now, what are the implications of that on the stock market? As the stock market becomes riskier and more overvalued, you will see an exodus from the stock market into these bonds with higher interest rates and safer assets to move your money to. That would be negative for the stock market, and in the long term will increase bond prices. In the short term, the prices will go down as the yields go higher, but then you will see the balancing out with the exodus from the stock market into the bond market. Prices will rise again and the yields will stabilize lower. And this is exactly what I said in yesterday's video. I said if you look at the yield curve, you will see steepening of the yield curve and a rotation to the left side, meaning that the lower end will dip into negative territory and the 10 to 30 will increase in yields, and then everything will sink down like a Titanic ship into lower interest rates and negative rates, even more negative in the shorter end of the yield curve. But let's go back to the 1970s example, because this is what Fed President, the Dallas Fed President Kaplan said today in CNBC, and this is important to listen to.
To me, this is not a formula. It's not a commitment. It's not an we're not going to use an arithmetic average. It simply means to me as we get down to lower levels of unemployment, I'm going to be willing to, I'm going to look at a whole range of circumstances and factors. And if I think inflation is likely to be muted, I'm willing to take a little bit more risk and have a little more tolerance for a modest overshoot. And I say modest overshoot. But that's really been my reaction function for the last 2 or 3 years.
But President Kaplan, you're the ones who use the word average. And at the same time, you and Chair Powell said it's not a formula. So the word average begets markets are going to start thinking about a formula. So I have to ask you, if it runs at 2.5% for a year or 3% for a year, does that mean you would sit tight?
It'll depend on the circumstances. I wouldn't. For me, the new framework says we're likely to let inflation run moderately above. What does moderate mean to me? Probably means to me 2.25%, 2.5%. You've heard me say before over the last few years that our inflation target was symmetric. I don't want to run persistently below, and I don't want to run persistently above. And for me, at least, that hasn't changed. And so I know people may try to come up with arithmetic averages, but I won't be following that. And I will. This framework also is not a substitute for my judgment. I'll be looking at a whole range of factors when I make these judgments in the future. And it's not a commitment, again, on what we're going to do.
And as you can see or can hear, he is assuming that the Fed has total control over inflation, that the Fed can shut off the tap and open the tap manually and can control inflation. Even if it overshoots over 2%, it is easier to control. That is a fallacy, because we've seen what happened back in the 1970s. The Fed made the same assumption and they failed, and we had the highest inflation in recent history, and it caused stagflation in the economy, and it was a very bad period. You can ask your parents back in the late 60s and 70s, was it easy to buy a home or a car? Because the interest rates got crazy. It was so expensive to get a mortgage and buy a car, and that caused stagnation in the economy. The stock market dropped 50% in the 1970s, and this is what the Fed is risking getting us into again. Now, how did the phenomenon in the 70s end? Meaning, what solved the high inflation? Because the Fed assumes that if they play with interest rates, if they lower interest rates, they can push inflation higher. And if they jack up interest rates, they can control inflation when it pushes over 2%. Here is the fallacy. And let's read this. This is actually from the Fed's own website. How bad was the period of the Great Inflation? The inflation rate, a mere 1% in the 1965, hit 14% by 1980. Unemployment trended up from a low of 3.5% annual average in 1969 to 9.7% in 1982. So the whole higher inflation thing backfired actually. The stock market was in the dumps, oil prices jumped off the charts, and President Richard Nixon and Jimmy Carter became desperate enough to tinker with price controls, the results being disastrous. And here is how the problem was solved. It was Fed Chairman Volcker who changed everything, and of course was an exception that he was not one of the Fed morons who lead the Federal Reserve today. He was a smart person, and he knew exactly what he needs to do to fix the problem. Volcker, in office only 2 months, took the radical step of switching Fed policy from targeting interest rates to targeting the money supply. Keep that in mind. The money supply. That's the secret term here. The days of easy credit turned into the days of very expensive credit. The prime lending exceeded 21%. Unemployment reached double digits in some months. The dollar deappreciated significantly in foreign exchange markets. Volcker's tough medicine led to not one but 2 recessions before prices finally stabilized. So this is the risk. If inflation gets out of hand and we reach stagflation and the Fed loses control, we're going to have to go back to the tough medicine approach. And that would not be good for the economy or the stock market at all. Now, here is my opinion on how to do increasing inflation and reducing unemployment properly. Number 1, you have to actually increase interest rates, not decrease. And I know that sounds radical, but when you think about it psychologically, if the Fed announces that they're going to jack up rates in the months to come, what will happen is businesses and banks will scramble to lock in loans right now with the knowing that interest rates will increase in the future. That will also spark an activity in the microeconomy where consumers have taken advantage of loans before interest rates get higher. The psychology alone of knowing that interest rates will increase in the future will stimulate activities in the economy and expansion in the economy overall. Now, add to that, instead of sprinkling and spraying all that money, trillions of bucks into corporations and corporate bonds, in the tune of billions and even trillions of dollars in bailouts and all that garbage. If you extend the help into stimulus for consumers directly, meaning giving American people money in their hands instead of giving it to the corporations and the bond market, what will happen is you will increase the consumer purchasing power, and now people have more money in their hand. They will go and buy things, stimulating the economy further, and the demand itself will create inflation. Prices will rise temporarily, and then you will see the supply surge to counter the demand. The supply surge means more economic activities, more economic production to meet the surge in demand. It also means expansion, which means more hiring, more employment, because the demand is there in the economy again. And consumers, when they run out of the stimulus, they know that they need to purchase and buy and continue to buy because inflation will increase and prices will increase. So they will look for jobs again. And now you have supply of jobs meeting demand of jobs. You have a wholesome economy where consumer purchasing power is recovering and the expansion engine from the corporate side is roaring again. But don't expect the Fed, of course, to take that approach because they're guided by the billionaires and the banks and the corporations who lead the Fed from the shadows. And what they will do is negative interest rates and further liquidity and further money supply just to make the rich richer. And then who cares what happened to the economy? Stagflation, no stagflation, who cares? As long as the rich keeps getting richer. All right, I think we said enough about this subject, so let's move on. And here we go, the TikTok saga. We have Microsoft teaming up with Walmart now, trying to buy Walmart. And of course, you saw the stocks of Microsoft and Walmart surging today. And we have more news about unemployment and the whole airlines firing pilots. United Airlines now announcing the firing of 2,850 pilots, in addition, of course, to the 2,000 that Delta fired earlier in the week. And now we saw, of course, American Airlines shutdowns, firing 19,000 workers. Most of them are flight attendants. And now, of course, you have 2,850 pilots from United Airlines. But perhaps the big news of the day, of course, came from Abbott Laboratory. They've announced a new testing kit for COVID-19. It takes 15 minutes to give you the results, and it's $5 per test. This changes the game right away. What we need is not a vaccine. A vaccine will not change anything. Younger people are not going to get it unless you force them to. This is, of course, goes against the whole democracy thing. And the vaccine itself will need multiple doses because we've seen from the trials that the antibodies are temporary and you will need more shots of the vaccine to sustain your antibodies against the virus. Who's going to track that? Who's going to track that you're up to your vaccination? The vaccine is not practical. The testing kit is, because now if you want to go in an airplane or in a casino, in a bar, whatever it is, they'll use that testing kit. They test you right away. They only let you in the premises, in the plane, if you test negative. That is it. That changes the game. And we will talk about the vaccine rotation trade in a little bit. But here is the government purchasing right away $750 million deal with Abbott Laboratory to buy 150 million testing kit. That is not enough for now, but it is a start, and it is very positive news to reopen the economy safely, and of course for the names in the comeback stocks, and we'll talk about them in just a little bit. Now, moving on to the heat map analysis. And of course, you see the big boxes that led the day yesterday are muted and trading in the red. Exception, of course, is Microsoft due to the TikTok deal. Microsoft up big today. If you look at the right corner, the upper corner in the screen, you'll see Walmart flashing green as well. Walmart up big today. And at the bottom of the screen, you see Abbott up about 8%. This is, of course, due to the news of the new testing kit. Abbott is very bullish right now, because this changes the game. And of course, you see real estate and financials trading in the green today. The breadth is a little better than yesterday, but we need a dynamic rally where financials and technology rally together. For now, we're still playing the yo-yo game back and forth. One day it's technology, the other day laggards. And here we go with the rotation trade. As you can see today, the comeback stocks, aka the laggards, aka the reopening stocks, are outperforming, catching a major bid. They were not underperforming by much yesterday, but of course they outperformed by a lot on Monday, and now they're overperforming again. And you see technology, aka stay-at-home stocks, are muted. Of course, they had a massive day, specifically the tech stocks yesterday. Today, they're muted. We still haven't made our mind yet. We're still in the yo-yo game, but the more we hear about the vaccine and the testing and the reopening of the economy, trust me, the market will make up its mind, and you'll see the technology names, the high-flying names being sold out, or sold off rather, and become the ATM where the cash comes out of and rotates into the comeback stocks. You will see a lot of FOMO happening now. When you see Ulta, for example, Ulta Beauty is up about 20% after hours now due to their earnings. When you see those numbers, Live Nation is up over 8% today. You will see FOMO from those who are holding Apple and Microsoft and all that garbage right now, thinking that they're just going to go up to the moon. They're going to see these names lagging and looking at the other side, to the right-hand side, the grass is greener. They're going to hit the sell button, taking some cash and moving it to the comeback stocks. And you see this rotation accelerating in the days and weeks to come. That is, of course, my personal opinion, my 2 cents. And now switching to the charts analysis and starting with the SPY, the S&P 500, 15 minutes perspective. As you can see, we're overextended, we're overheated, and we struggled to march today. We stayed pretty much in a flat range, going back and forth and closing the green by a little bit. But I am, of course, expecting a pullback all the way to close the gap to the resistance line, now support line. That is the healthy way for the chart. It needs to go back, visit the support line, and test the support line whether it works or not. But just gapping above it and continuing to march higher will only be a recipe for a big crash down that will overshoot beyond the support line. So we're waiting for the SPY to pull back. And likewise, when we move to the triple Q chart from a daily perspective, of course, here's the trend line. We talked about the trend line yesterday, and every divergence from the trend line was corrected. And now we are diverging by about 8% or more. And you see, we saw a little bit of a correction today, a beginning of a correction. It's not a big correction, meaning the crash, but it means the pullback to the trend line. That is the healthy way for the Qs to operate right now. They need to pull back down to the trend line and catch support from the trend line. We will only turn bearish on the Qs and anticipate the big correction if they pierce below the trend line. And if you go to the weekly chart and you watch the MACD and you see the MACD curling down, passing the blue line, the average, and making red impressions in the MACD, that would be a signal for the big correction in the tech sector. For now, we're looking for a pullback, not a crash. And moving on to the TNX, the 10-year note yields. We've been watching this for days now, and as I told you, I did not trust the reversal candle from Monday, or rather Tuesday, and now you see, of course, that the TNX is rallying big again because it's been gathering energy in the bull flag for a long time. So you have to expect the breakout to be a little more impulsive. You saw the TNX rallying. Today, I expected to rally a little more until we see a signal of exhaustion and a reversal. Now, what about gold? A lot of traders are assuming, of course, due to the Fed's commitment of letting inflation go higher, the Fed or the gold trade is a no-brainer now. I do agree with that, but I think that you have to open smaller positions now. Open a small position, and as you can see from the chart, wait till gold closes above the breakdown candle. You see the breakdown candle, the big down red candle? Wait for gold to close above the high end of that candle from a daily perspective and then jump in heavy. But for now, you open an opening position and you wait for that closing and then you add a bigger position. Because yes, if the Fed is committing to higher inflation, that would lead to higher prices in gold. And now let's take a look at the VIX. The VIX from the daily perspective, it was a lot higher earlier in the day and it closed in the green still. And as you can see, it's making a green impression. And if you switch to the weekly chart, it is making the second week in a row now for a green candle. Here is what I'm waiting and watching for. The MACD. If we do curl, crossing the blue line, the average, making green impressions on the MACD, that would be a signal of the reversal in the VIX. The VIX will shoot up and that would translate into a reversal in the SPY and the stock market overall. Now, let's conclude this video. We do have, of course, some economic indicators coming out tomorrow. The consumer purchasing power, that is important. But we also do have the news that we heard yesterday about the Abbott testing kit. That changes the game and it makes the rotation trade more attractive now. And as you can see from my own personal moves in my own personal portfolio, I'm increasing my stakes. I'm adding more positions from the comeback stocks into my portfolio, and I'm starting shorting positions from the momentum stocks that flew really high. Add to that, of course, a commitment from the president to release the vaccine before the election, and now you have a lot of tailwind for the laggard stocks to outperform. Furthermore, a commitment from the Fed to increase inflation that perhaps translate into negative rates or even further lowering of interest rates would help struggling businesses more than big thriving businesses. Airlines, casinos, cruises, restaurants, all the laggard stocks need all the help that they can find, whether it's from bailouts or from loans. And now, if we have a commitment of even lower interest rates, then the recovery will be a lot easier for these names than it was before. But keep in mind that the Fed's statement and decision today, it's pretty much waving the white flag that they cannot fight inflation, they cannot control it anymore, so just let it be, and they will continue to lower interest rates if they need to increase inflation. It's pretty much the Fed saying, hey, we've done everything we can. We flooded the market with a tsunami of liquidity. We flooded the economy with bailouts, of course, with purchasing of billions and billions of dollars of treasuries, funding the government, and we have lowered interest rates all the way to zero, and we might go to negative interest rates, but that's all we have. Now it is on the lap of the government to do a stimulus round. The Fed is telling the government, now it is your turn to release a bigger stimulus for the economy. Whether you agree with the ramifications of that decision long term, it is increasing the national debt or not, it is what's needed right now to stimulate the economy further and to help the stock market. So this is what I see from a psychological point of view in the stock market. I see a pullback that will accelerate and become more severe as we head into September. It will be a big pullback, but it will not be the crash and the correction, because it will motivate the creatures in Congress to come up with a deal and release the stimulus. Remember, if we pull back and we start having big red days, and then Congress comes out and say, hey, we forgot a deal. We have a deal now in stimulus. We're giving $1 trillion bucks. or $2 trillion bucks, and that includes checks to America of $1,200 or more. That would save the stock market from the decline and will be bullish turnaround for the market, because you know a lot of that stimulus will go into Robinhood accounts and will start betting again. They're addicted to the game. They will start betting, buying calls, buying stocks again, and that would be a positive dip for a reversal from the decline. Whether that is sustainable or not, that's another question. We'll take it when we get there. But for now, I see a big pullback that will be frozen and rescued by a stimulus from Congress. The VIX is giving us the signals for that. The VIX is ready to pop in September or perhaps earlier than that, and that would translate into a reversal in indices until the rescue operation from Congress happen. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.